Well, joining us now is Tim Evans from Longleaf Trading Group. He joins us now from the CME in Chicago. Tim, hello to you. Thank you so much for joining us today. Just wanted to get your take on those moves, particularly by Saudi Arabia in the oil space.
Hi, Natalie. Nice to be with you today. Yeah, I mean, my individual take on it, I mean, is really, I think we're seeing seriousness expressed from all parties involved. I mean, there was a lot of concern and I think skepticism that, this deal probably wouldn't be complied with, and, all the various parties involved in making this actually happen, wouldn't approach it with the seriousness that's needed. But, obviously with Saudi Arabia, coming together with Moscow to not only signal future compliance with the deal, but to add to the levels of the cut. So, I mean, I think the market's taking this a lot more serious, and I think that's again reflected in the opening prices we saw last night when the market began to trade.
Well, absolutely. I mean, you and I have discussed in the past couple of weeks, in fact, just how much this decision can be trusted. But really, all indicators pointing to the fact that OPEC and non-OPEC members are serious about these moves.
Yeah, absolutely. I mean, I was one of the biggest skeptics of all, and I seriously doubted the willingness and the ability to comply. I think the willingness aspect has been addressed. They were able to bring in, if you consider Saudi Arabia and Moscow, they've had a lot of political differences, with the Syrian civil war. And they were able to put those differences aside to, come to an agreement to, further this production cut along. So, again, it does speak to, the seriousness of this deal overall.
So let's take a look then at what this has actually done for price performance. And we have a chart to show for viewers, and it really highlights volatility essentially vanishing for oil as OPEC and non-OPEC accord sends prices surging. So as you can see on that chart there, we've got the white line. It's the CBOE oil VIX index, highlighting it at its lowest level since June 2015, whereas the blue line that viewers can see is the WTI price, and that's at its highest since July 2015. I mean, we've seen oil now up 20% since the OPEC announcement less than 2 weeks ago, Tim. I mean, where can prices go from here, particularly as we can see on the screen at present? That volatility really has evaporated.
Yeah, well, I mean, the volatility got kicking off to it was very high last night, just put it that way. I mean, we had a lot of market participants that had to reverse positions. I mean, there were some short positions built on a lot of the things that you and I have been talking about over the last couple of weeks, and that's down to the seriousness of the members of OPEC and non-OPEC members to carry out this production cut. But, that reversal took place and we skyrocketed higher. I think we've tipped over here throughout today's session, because at the end of the day, it's going to be difficult for the market to sustain prices at $55 or higher, because the wild card now is the U.S. shale industry. They've shown in the past that the rally we saw when they first floated that rumor that they would be cutting production, that prices got up to that $52 level or so, and then we saw very aggressive producer hedging at those levels, and I think we're now seeing aggressive producer hedging again at these prices. So, and I think that's something we're going to continue to see in the near future. So, I'm not expecting much through the $53, $54 level here in the coming weeks.
Now, Tim, I know you're also watching bonds quite closely, and obviously oil prices currently contributing to the sell-off in treasuries. Just walk us through your outlook and guidance in this sector also.
Well, I mean, the price action that we're seeing in oil is similar. I mean, while the behavior is different, the action is very similar to what we're seeing in other commodity markets. The market is pricing in, the expectation of inflation in the future. Bond prices are mimicking that in terms of yields going higher and higher here as we're approaching Wednesday's Fed meeting. And, in the 10-year note, we, touched down over 2.5% on the yield for the first time since 2014. So, that's the way the market's pricing it in. And I think the market's expecting, comments from the Fed to be a lot more hawkish here on Wednesday.
Well, because what we're watching from the Federal Reserve is not only expectations for Federal Reserve, monetary policy path next year, but also, I guess, also fiscal policy path from what will be a new administration under Donald Trump.
Yeah. Yeah, I mean, and that's really that's the one thing that everyone's trying to figure out, Fed and non-Fed people. I mean, number one, what policies, fiscal policies are they ultimately going to be able to move forward with in that first 100 days? The market, I think, is signaling, that there are policies that are ultimately going to help inflation and pro-growth policies, and that the Fed is going to ultimately move forward with monetary policy in accordance with that. We were looking at the Fed or market participants pricing in about a 25 basis point hike 3 weeks ago or 4 weeks ago, and now the market's pricing in, at least the last time I looked today, about a 95% chance of a 50 to 75 basis point hike. So, I mean, clearly the market's looking for the Fed to, alter its monetary policy moving forward based on the changes that we're expecting to see in fiscal policy.
Absolutely. Just to get your idea then, what are you expecting from the Fed next year?
That's a very good question. I mean, there's still so much uncertainty in terms of what the Trump administration is going to be able to get passed through Congress. I mean, I at this point am a skeptic that, a lot of these pro-spending plans, these infrastructure plans that, the Trump administration transition team has been signaling they're interested in moving forward with, that they're going to be able to get that through Congress. If they are, let's just say they are, I think that we could look at pretty regular increases going into June of next year. Obviously, we're going to have to get data dependent at some point to see, what kind of impact these policies are having overall on the economy. But, if they're able to get it through, I think we could just see these rates edge higher based on Fed action. What's interesting is we're bringing in kind of a new tool on Wednesday's meeting, which is the dot plot. And that's going to give us insight into what each individual Fed member thinks that we'll see with respect to the Fed funds rate over the next 3 years. And why that's valuable is we get to see their personal view and how they think these new Trump administration policies, the kind of impact that they're going to have on the economy. So that's going to be some very valuable information I'm looking forward to seeing on Wednesday.
Absolutely. I think we're all kind of waiting on tenterhook slightly for that one. Tim Evans, thank you so much for your time today.
Thanks, Natalie.